By the way, the project one is due. So anyway, so this is a much easier version of project one. So let's look at this theory for income, how to use income statement. So let's look at this. Let's look at this. This is a graph here. So let me explain what does the idea. What's the idea behind it? Um, Let me give you an example. So uh, let me give you an example. So let's say Apple sold a product with Microsoft. They don't buy it from each other. Let me just make it a hypothetical example. Okay, let's just say Apple sold 1 million product to Microsoft. So the contract, the sales is $1 million. Let's say the profit is $1 million. So what's the example about is what we found is the contract can be repeatable. So which means next year the Microsoft and the Apple, there's a 40% of chance the contract, the 1 million contract, will be signed again. That's the pattern we actually, that's the theory we have. So if that's the case, one question I ask you guys is, when Apple signed up a contract with Microsoft with $1 million, would you consider the contract is $1 million when you evaluate Apple, or you consider as $1.4 million when you evaluate Apple? That's my question. So my question is, if you know the contract will be 40% of chance renewed next year, so when you evaluate the value, the stock price of Apple, would you consider the contract value as $1 million or $1.4 million when you evaluate Apple? We should supposed to do $1.4 million if we know for sure there's a 40% of chance the contract will be renewed next year. Does it make sense? Does it make sense? Does that tricky? Sounds tricky? Okay. So this is the theory behind. This is theory behind. So what we're testing for is we can calculate the likelihood of the contract will be renewed the next year, which is 40%. We want to test whether other people know the 40% of chance of renewing contract. If everyone knows that, that means what? If everyone knows that, that means everybody will consider 1.4 million contract instead of 1 million contract. If everyone knows that, okay. If nobody knows that, then during the evaluation, everybody will consider $1 million contract instead of 1.4. So is the question, is the setup clean here? So basically, so 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 if everybody know the contract will be renewed 40% chance next year, everybody knows that, then everybody will put $1.4 million valuation for Apple. If not, you will put 1 million. So we want to test, does the information we know also other people know? So we want to test that. I tell you the results. The results is only people, not everybody know that. We found people only evaluate $1.2 million into the contract. So basically there's a lot of portion. There's a 0.2 million portion are not incorporated into the stock price. So what I was saying is the other people, the investors, only consider 1.2 million contract value for the Apple instead of 1.4. So that's why we can form the trading strategy. That's why we can form the trading strategy here. So what do we do here? What do we do here is look at the formula here. What is the formula? The SUE is the earnings, and you can consider as a contract. And this is the next year contract. So we first run the regression. One regression, we get the coefficient here. What kind of coefficient here is, this is the 0.4, which means every dollar contract we have here, there's a 40% chance the contract will be renewed next year. So this is a 0.4. And the next, what we do is, hello? Can you guys hear me?
Yes, Professor.
Oh, okay. So you can understand SUE as a contract. So every $1 contract here, the next year will be 0.4. So means every $1 contract, there's a 40% of chance will be renewed next year. And then we want to test whether investors know about this 40%. So we use the SUE to predict the next year's return. So the idea here is if everyone knows the SUE can predict it's 40%, then we don't see any abnormal return because this is future period. This is the future period. If if investors do not know the 40% of chance of renewing contract, then the SUE will predict the future abnormal return since this is the future. So let's look at the graph here. Let's look at the graph here. So if you look at the graph, so let's look at the just long and short. I don't want to make it too complicated for you guys. Let's look at the long side. For the long side, so this is time T, right? Time T, we have the contract announced. So what I want to say is if everybody understands the nature of the contract, then the stock, the market reaction will incorporate the contract for $1.4 million. However, because the market only incorporated $1.2 million in the time T, so the rest of $0.2 million will be gradually impounded into the stock price over the T+1 and the next earnings announced period. So so that's the idea for this project. So basically the idea here is during the time T, the investors only understand $1.2 million of the contract value. They missed $0.2 million contract value. So, but over time, they gradually learning. So over the next 3 months, they gradually learned that the $0.2 million, it's also can be renewed. They learn the information can be renewed. So you can gain like $0.2 million profit from the trading in the future period. So in other words, let me just repeat this one more time since this is a little tricky here. So in other words, if investors evaluate this contract by $1.4 million, you will not predict anything in the future because everything has been incorporated here. The reason why the SUE can predict the future stock returns is because they only incorporated $1.2 million in the time T, and the rest of $0.2 million will be gradually impounded into stock price. Is that logic clear? I know this is some little bit tricky part, but is that logic clear? One more time, I just want to say, if everyone understand the persistence of SUE, if everyone understand the 1 million contract will be continuing the next year. If everyone evaluate the contract as $1.4 million, the SUE will not predict future returns because every information is understood here. The reason why SUE can predict the future stock returns because there's a proportional information missing. Investor only put $1.2 million. The $0.2 million contract are not incorporated in a timely fashion at the time T. So there's a future time, so you can trade on. So basically, you know something other people doesn't know here. At time T, you know something other people doesn't know, so you buy the stock. And over time, when other people learn about what you know, and the stock price go up, and you can gain a trading profit. So basically, that's the idea. Okay, that's the idea. Just last time, I just hope you can get. So basically, at the time T, you know something other people doesn't know, which is you know the value of the contract is $1.4 million. You know something other people doesn't know, and then you buy the stock, and over time, other people will gradually, slowly learn that the contract is worth more than $1.2 million. So you can gain a profit because you trade ahead of other people, and you can gain a trading profit from the future. So that's the that's the one example how you understand the income statement by using the persistence of a contract. And another thing is you have to make sure the profit is not from the transaction cost. You know, when we buy stocks, you buy and sell. There's a spread. When you buy and sell, the bid-ask spread will consume a lot of a trading transaction cost. So what you need to do is you want to take care of the transaction cost. So you want to see the stocks which has low transaction cost can also generate profit. So that's the idea. So basically, the idea here is the free here. You want to make sure you know something other people doesn't know, so you buy the stock. And over time, when other people start to realize what you know, you gain profit. Here, you want to make sure the profit can cover the transaction cost. You don't want like you gain like a 1% 3 days. If the transaction is also 1%, you gain nothing, right? You want to make sure the profit you obtain from the trading strategy can cover the transaction cost. That's actually the um, that's actually the idea we have. So this is the test we have now. You can see that the strategy what you have is about the 3 day return is 0.7%. This is pretty high. So so over the 3 months is 6%, 6%. So what does that mean? That means if you buy and hold, if you use this strategy, buy and hold 3 months, it's about 6% for 3 months. And then if you do 3 days, it's about 0.71% for 3 days. I told you guys the importance of doing 3 day return, right? So so what I'm saying is if you buy the stock here and over from here to here is 6%, and over the 3 day here is 0.71%. Let me repeat it one more time. If you buy stock here and over from here to here 3 months, you gain 6%. If you only buy the 3 days here, if you only got buy and hold 3 days here, it's about 0.71%. So that's pretty high. I told you guys the importance of doing a 3 day return, right? The importance is 3 day return is less risky. It's less risky. If you can get profit from 3 day return, it probably shows that you can generate good trading profit. So it's about so this is about the trading strategy is about 6%, 6% for the 3 months buy and hold, 0.71% for the 3 day. So and this is a transaction here. So basically, what does that mean? This means if you consider the transaction, if you adjust for transaction, the return will be even higher. So here, you add them together, so 11%. So if you take out the transaction cost, you can get even 11% for 3 months. Here is about 1.3. You add them together, zero point 0.7 add 0.6, you add them is 1.3. So basically, the idea here is if you consider the transaction cost, the return is even higher. It's even higher. So that's the idea of the idea of this trading strategy. So basically the first is you can gain return by if you understand the persistence of the contract. Other people doesn't understand it. That can give you the 6% 3 months and 0.71 over 3 days. And if you can consider transaction cost into the model, and the return is even higher after you what you take out the transaction cost, it's almost double. It's about 11 months, 3 months, about 1.3 about for 3 days. So this is the trading strategy one example I was talking about. So this is always you guys should do the annual day. You can see it from 2018A, from 2008. You can how stable is this? So you can see the profit you made. The green one is the combined strategy. You can see that it's pretty high over time. You see, it's always above zero, right? Always above zero. In 2008, there's some crash on the 2008. So basically, if you follow the trading strategy, you only get something wrong on the 2008. Other than 2008, over the past like 20 years, it's pretty good, right? It's pretty good. So this is over time, this is the performance. So when we do Pharma Mac Best, that's what I said. You have to average out annual effect into the Pharma Mac Best. That's earlier I was talking about that. So another thing is the quarterly return. So this is annual. This is 3 day. I'm sorry. This is 3 day. This is quarterly. So basically, this is 3 day return from 2018 to 2008. You can see that every year you make money except 2008. And look at the quarterly. You make money almost every year. Not almost. All every year. You at least the minimum is 5%. You see, minimum is 5% from the 2000 from 1987 to 2008. So most of the years you are making money on that. So this strategy is very a classic trading strategy using by hedge funds. It has been so it has been a while. So what I want to tell you guys is the red line is a classic trading strategy used by hedge fund, but the green line is the strategy I invented. So so basically I adjust for the after I adjust for the transaction cost, the classic trading strategy was doubled. And here you can see that the conventional model, you can see that it also makes money. The green line is the strategy I created. I also use that. Some investment firms also using my trading strategy too. Now it's relatively new. I developed the trading strategy in 2011. So 2011. So basically the red line is the classic one. Everybody are using hedge funds. The green ones are the ones I developed. So basically I take care of the transaction cost. The profit were doubled. So it's on the 3 days, it's like this. On a quarterly base, you can see that quarterly the red line is the trading strategy classic one. The green line is the one I developed, and you see the profit is better. So 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 yeah. Yeah. So this is the idea. So basically, the idea here is how you should use income statement to provide useful information for investors. So in here, the example is for investors, but later on you can use the income statement to provide information to managers and a lot of people. So so um, so we talk about how to test, what's the theory. So going back to my earlier points, what we want is so what we want is you use these 250 variables. Either you have a theory based prediction, or you have a machine learning based prediction. Here is theory based. The theory here is what? Theory here is we want to know that the contract can be renewed next year, and we test whether you are the person know it, other people don't know it, right? This is the theory here. And we talk about different ways. We talk about how to do the testing, how to adjust returns. And we also test we explain the idea, the timeline, and the transaction cost, and you can understand the regressions, and you understand the profit, the green line and the red line. So this is just one example. This is one example how you can use income statement to help investors. And there's millions of examples. You can use the income statement to help investors, to help managers, to help a lot of people. We'll talk all about that in the rest of class, and you also can think about it. And this is about this. How about um, how about let's